everyone, and welcome to Money Show's virtual event. Next up is Peter Schiff, the Chief Economist and Global Strategist for Euro Pacific Capital. Peter is going to tell us why the Fed's higher inflation promise will send gold prices soaring. At the end of the session, if there's time, we're going to take some questions. So if you want to type them in the box on the right side of the platform, I'll pass those along to Peter as we get towards the end. So Peter, thanks for being here. Please take it away.
Oh, thanks for inviting me. I think I was just here. What was it, a couple of weeks ago? We did another Money Show event.
That's right.
But this one, I think, is more specifically focused on gold. And I think it's a good time to be doing this because I think gold is going to go on probably one of the biggest, if not the biggest, bull markets we've ever seen in gold. And we've certainly seen some big bull markets. Really, the biggest one was the one that we had in the 1970s. And so not that many people really remember that. They weren't around or they were little kids. I, was, pretty young during the 1970s myself. So I don't have as much experience with that market. But gold went from $35 an ounce at the beginning of the decade to over $800 by the end. And that is a spectacular increase. And the reason that that happened was because we went off the gold standard in 1971, but what caused us to make that mistake was the fact that we had abused the privilege of the US dollar functioning as the world's reserve currency. The US dollar became the world's reserve currency because it was backed by gold, and not only just backed by gold, but it was redeemable in gold on demand. So when you had Federal Reserve notes, you had IOUs for gold. That's what dollars were. They were a weight of gold. And we convinced the world to hold on to Federal Reserve notes rather than the bullion itself because they could get interest on their Federal Reserve notes by buying US Treasuries. And they got no interest on their gold. So this was a great way for foreign central banks to back up their currency with gold, but simultaneously earn interest on US Treasuries because the US Treasuries were not only as good as gold, they were better because they paid interest and gold did not. So once we got the world to accept this, we immediately took advantage of it because now we had all this foreign demand for US Treasuries, and that enabled the government to run larger deficits, which by today's standards are tame. But back at the time, they were large, but they were funded by foreign central banks. And so that allowed the government, first, Lyndon Johnson in particular, the guns and butter economy. We were able to have a war in Vietnam, yet also have a war on poverty, which, by the way, poverty won. But we had the war on poverty, Great Society programs. We went to the moon. We did all this stuff. And we didn't raise taxes sufficiently to pay for it. We were able to go into debt, and ultimately, because we had done this, the world began to question the ability of the United States to make good on its commitment. Did we really have enough gold to back up the money that the Federal Reserve was creating? And the answer was no. But when the world tried to withdraw their gold, we defaulted. And then the dollar really tanked, and there was less demand internationally for dollars because they were no longer backed by gold. And so the money that the Fed was printing had immediate impacts on consumer prices, and we had the stagflation of the 1970s, which didn't come to an end until 1980, after we had elected Ronald Reagan, who promised to shrink government, to rein in all the debt. And we had Paul Volcker, and Volcker allowed the markets to put interest rates up to a level that would put a floor beneath the dollar and a ceiling on gold. And of course, rates moved up to 20% in the early 1980s as a result of the Federal Reserve allowing the free market to function and interest rates to kind of find a free market number. And of course, that was a very difficult time for the U.S. economy because obviously 20% interest rates, if you have debt, it's pretty difficult. And so we had a very severe recession early on, but that basically saved the dollar and ended that huge bull market in gold, and gold went into a bear market for 20 years. It didn't really emerge from that bear market until 1999, 2000, 2001, that time frame, kind of when the dot-com bubble peaked in the United States, and gold actually found some support around $250, $260 an ounce, significantly below the 800, 850 peak that it reached around 1980. And then we had another bull market in gold, where gold went all the way up to 1900 in 2011. And the reason that that bull market came to an end, other than the fact that it had been an extended run, right, from under 300 to almost 2000, uninterrupted, 10-year bull market, was that the public became convinced that the Federal Reserve could do the impossible. That even though it unleashed QE, it did QE 1, 2, and 3, and even though it had lowered interest rates to zero, and in so doing engendered a massive amount of speculation and debt, to the point that the U.S. economy, after the 2008 financial crisis, was much more levered up than it was before the financial crisis. So a crisis that was caused by excess debt, the government's cure for that was to load us up with even more debt. But then the Fed convinced the world that despite all this debt, that the Fed would be able to take away the punch bowl and the party would keep going. That the Fed would be able to normalize interest rates and shrink its balance sheet, get rid of all the excess liquidity that it put into the system following the '08 financial crisis. Now, I was saying at the time that this was impossible, that it was wishful thinking at best, but more likely just outright fraud. But the markets believed the Fed. They ignored me and other people that were making similar observations that I was. And because the markets began to look forward to the impossible, right, the normalization of interest rates and the shrinking of the balance sheet, gold entered this bear market. And the bear market actually continued all the way until the Fed finally got around to doing what the markets had been discounting would begin, which was raising rates. And they finally raised rates after, bluffing about it for a long time. They finally raised rates in December of 2015, long after the bear market began back in 2011. And so when the Fed finally raised rates for the first time, that's really when gold bottomed. It bottomed at December 2015, January 2016. And then it began to recover, but it didn't get back to the 2011 high, but we put in a nice bottom, a really good support. And gold started to break out of that level really in the end of 2018, because what happened at that time is that's when the Federal Reserve finally reached the breaking point. It had raised interest rates to the point where the markets could no longer handle the level. And that was around 2.5%. So the Fed never got back to normal. It started a journey that I said it could never complete. And at the same time, the Fed had to call off quantitative tightening. They had to give up shrinking their balance sheet well short of their goal. And the reason the Fed was forced to do that is because the market started to hemorrhage. In the fourth quarter of 2018, all hell broke loose. The market was collapsing, and the Fed had to do an about face. Now, it was very coy in what it was doing. It pretended it was like a mid-course correction. It wanted to deny the obvious. And in fact, even in 2019, when the repo market started to break and rates started to spike, the Fed was forced to go back to quantitative easing, only they refused to admit that it was quantitative easing. They pretended that there was some kind of a difference between the money they were printing when they were officially doing QE and buying government bonds and the money they were printing now or in 2019 to buy government bonds. But it was all the same thing. So the Fed had basically proved what I had said since the beginning, that they had checked the economy into a monetary roach motel and that there was no way out. And it was QE infinity. and it was going to be, the balance sheet was going to grow in perpetuity. But then we ended up with COVID-19. And now the Fed basically gave up the pretense of a mid-course correction. Interest rates went all the way to zero, and we went to full-blown QE. And in fact, another one of the predictions that I made from the very beginning was that QE4 would end up being bigger than the first 3 rounds combined. And that prediction has already come true, and QE4 is just getting started. We've got a long way to go. But the significance here is that now the market knows that they were wrong when they believed the Fed, when they believed that the Fed had an exit strategy and that they can normalize rates and shrink the balance sheet. That's why gold has now taken out its 2011 high. Gold got above 2000. In fact, we came, I think, to within $20, $30 of 2100 before we pulled back. Gold is now building support above the old record high. Gold is trading above 1900, and it's getting ready for another major leg up in this bull market with no way to stop it, because nobody is going to believe, even if the Fed tries to repeat that lie, nobody is going to believe that the Fed can ever move rates above zero. Nobody is going to believe that they can shrink the balance sheet. If they couldn't shrink a $4.5 trillion balance sheet, how are they going to shrink it when it's $7 trillion? And of course, it's not even finished growing. It's going to go to 8 trillion, 9 trillion, 10 trillion. So the bigger the balance sheet gets, the more impossible it is to shrink. And the longer the Fed keeps interest rates at zero, the harder it is to normalize them, because you get the economy addicted to the cheap money. And because money is so cheap, everybody takes on more debt. And the more debt you have, the harder it is to service that debt if rates go up. That's why the whole thing imploded in 2018 when rates were at 2.5%. The economy has much more debt today than it had back then. So it would buckle at an even lower rate now than it did then. That's why the Fed is now making up excuses why it needs to allow inflation to run hotter, because it knows that it's stuck in this box. It is telling the markets, hey, don't even worry. We're going to keep rates at zero for at least 5 years. We're not even thinking about raising interest rates. And the reason they have to say that is because they have to give the economy the confidence to keep taking on more debt, knowing that the Fed is never going to pull the rug out from under them. And that is what is driving the stock market higher. That is the only thing that is enabling consumption, is the promise by the Federal Reserve to continue to create inflation. But I don't look at that as a promise. I look at it as a threat, because inflation is not a good thing. Inflation is evil. Inflation is really an insidious government tax. And I'm not the only one that says this. I recently posted a video from 2019 where Warren Buffett described inflation as a tax. He said it's a cruel tax that not one man in a million understands. That's why Warren Buffett is now buying gold stocks. That's why he bought a position in Barrick Gold, because Warren Buffett knows inflation is a monetary phenomena. It's not a price phenomena. It is the expansion of the money supply, and it is a tax. If you look at government spending right now, government is only collecting about 40 cents for every dollar that it is now spending. So where is the government getting the other 60 cents if it's not getting them from taxation? It's getting them from the Federal Reserve. The Federal Reserve is basically monetizing these debts and printing 60 cents out of every dollar the federal government is spending. Now, does that mean we get that government for free? That since we're only paying 40 cents, that government doesn't cost $1? No, we're still paying for the 60 cents. How are we paying for it? We're paying for it with inflation. Inflation is a tax that is going to rob Americans of their purchasing power. Now, what is keeping some of these inflationary forces at bay is the fact that the US dollar continues to serve as the world's primary reserve currency. And that enables us to export a lot of the inflation to foreigners. Foreigners hold on to our dollars, invest them in bonds, government bonds, mortgage bonds, or stocks, rather than using them to buy products in competition with Americans and bidding up the prices. Instead, they send us their goods. The trade deficits are soaring right now. So we have goods coming in and the money is going out. And so that temporarily is keeping a lid on domestic prices. Even though prices are rising, they're not rising as fast as they could or as fast as they will once we have a dollar crisis, which is coming. I started by talking about what happened in 1971 when we went off the gold standard. Well, what's about to happen is the world is going to go off the dollar standard. This has been inevitable, and now we have accelerated the process. And it's not just COVID. I mean, we were headed for this depression even without COVID. COVID simply made it worse and created some false optimism that it's only about COVID. And if we can somehow cure COVID, that everything is going to be fine. It won't be fine. And the real damage is not from COVID itself, and not just from our overreaction to COVID, but from the monetary and fiscal policies that were part of that overreaction. It's the government that is inflicting far more pain. The Federal Reserve is doing far more damage to the economy than COVID ever could. But now that you've got the American public believing that they can have everything they want for free, people don't have to work, they can stay at home, and the government will just send the money that the Federal Reserve prints, that we can have more government, that we can have bigger government and tax cuts at the same time, right? This belief is now, infected, the whole political sphere. Voters want more of it. They want more free stuff. Even the Republicans want free stuff, and that's it. And so the world now is going to have to bring an end to this, because that's the only way it's going to stop. We're going to keep on spending money that we print until that money doesn't buy anything. And so what the world is going to do is they are going to refuse to hold dollars. They're going to start liquidating dollars. They see that the dollar is a bottomless pit. They know that there's no way that we can raise interest rates or allow interest rates to rise the way Paul Volcker did in 1980, because we have so much more debt now than we had then. It's impossible to pay a market rate of interest if the Fed gets out of the way and allows the market to function, which is why the Fed is committed to unlimited inflation, and they continue to print the dollar until it collapses. So I think foreigners are going to basically renounce the dollar, in that they're going to be reducing their holdings of dollars, and U.S. treasuries or U.S. mortgage-backed securities or any dollar-denominated debt. And there are a lot of people who think, well, Peter, that's never going to happen. The world can't leave the dollar because they have no alternative. I mean, they can't use the euro, they can't use the yen, the Chinese RMB. I mean, none of these currencies are ready to be the reserve. Therefore, the world is stuck with the dollar. And I would agree that these currencies aren't ready to be the reserve, but neither is the US dollar. And in fact, had the United States had the characteristics in 1970 that it has today, the world never would have accepted the dollar as a reserve. And of course, they only accepted the dollar as a reserve because it was backed by gold. But at least back in 1970, America was the world's biggest creditor instead of the world's biggest debtor. We had large trade surpluses instead of large trade deficits, and we had a viable industrial economy rather than a financial bubble engineered by the Fed. And so while I agree that I do not expect the euro or the yen or other currencies to replace the dollar, what I expect is for the world to go back to the monetary system that it had prior to accepting the dollar, and that is gold. I believe that gold will be remonetized. I believe that gold will once again be the primary reserve asset for all fiat currencies, including the dollar ultimately, and central banks are going to be increasing their holding of gold as they are decreasing their holdings of US dollars, and the price of gold is going to go up dramatically. In fact, one of the ways that gold is going to become a greater part of central bank reserves, it's not just because they're going to be buying more gold, but because the gold they already own is going to be so much more valuable. So as the price of gold rises in terms of these fiat currencies, then automatically the percentage of your reserves that are now gold versus fiat, right, increases as gold becomes more and more valuable. And this is going to happen. And then not only are central banks going to be loading up on gold, but you're going to see more institutions following the lead of Warren Buffett, right? Warren Buffett is now buying gold as a superior hedge against inflation. Now, he's doing it in the form of buying a gold mining company, but you don't buy a gold mining company unless you're bullish on gold. And when you're buying a gold mining company, what you're buying is the gold in the ground that is yet to be mined. So you're actually more bullish on gold when you buy it through a gold stock than when you just buy the physical metal, because you're taking a lot more risk when you're buying the company. But Buffett thinks the risk is worth the reward because he obviously thinks the price of gold is going much higher because he understands inflation. Now, in the past, Buffett has downplayed the reasons to buy gold because he's always said the best inflation hedge is buying a good business, a business that can pass on a higher inflation in higher prices. But I think what Warren Buffett was referring to is during periods of time where you have a normal low rate of inflation. That's not as bad. But I think Warren Buffett can now see the amount of inflation that the Fed is unleashing is not going to be normal. It is going to be much higher. This is going to be insidious. This is going to be worse than what happened in the 1970s. And now Warren Buffett realizes that he can't just buy a generic business and expect to have a real hedge against the amount of inflation that we're about to see. He needs to buy a business that's in the gold mining business because he knows that gold is the ultimate hedge against monetary debasement. And we're about to see an unprecedented amount of debasement of the US dollar by the Federal Reserve. And in fact, the Federal Reserve is telling you that they are going to do this. They are giving you fair warning that they are going to destroy the value of the currency. And it's important that you heed that warning. Right? I mean, this is probably the biggest buy signal I've ever seen for the price of gold, and that I've never seen it more obvious. Now, could you have bought in gold cheaper? Sure. But if you want to compare gold to other financial assets, look at the US stock market. Look at how much air has been blown into that bubble. I'd say that gold is cheaper today relative to the NASDAQ than it's ever been, especially if you want to look at the earnings of those stocks. So I think that gold, even though it's gone up in price, and even though you're paying $1,900, realize that you're getting a better value buying gold today at $1,900 than you were a few years ago buying it at $1,200. Think about how much more money is in circulation today than was in circulation then, and how much more is about to come into circulation. People don't realize that what we are experiencing now, this is not a temporary thing. The deficits that the government is running, these $3-4 trillion annual deficits, are not going away. They're going to get worse. Just like after the big debts that we ran up in 2008 and 9 and 10, the budget deficits never went back down to where they were prior to the financial crisis. They came down a little bit, but they never retraced to the levels they were at before the crisis. The same thing here. This is a new normal now that we have set. We have raised this bar, and we now have raised expectations among the electorate of how much government they can get for free. And in fact, a lot of the economic policies that the government has initiated in response to the recession that they caused is now exacerbating the recession. We're creating incentives for people not to work. And all of the monetary stimulus, the inflation that is being created specifically to prop up the stock market, is actually sedating the real economy. And we've created a situation where the more pain we inflict on Main Street, the more gain we have on Wall Street. And monetary policy is only focused on maintaining an asset bubble and maintaining the government's ability to spend beyond its means. It's enabling the government to run more debt. And as long as the Fed is telling the government that we will monetize all the debts that you want to run up, then there's no reason for anything to stop. That's why you have now the Republicans and the Democrats. The Republicans say, hey, let's print another $1 trillion and spend that. And the Democrats say, no, that's not enough. We need to print $3 trillion and spend that. Nobody is saying that we shouldn't print any money. Nobody is against the concept of monetary fiscal stimulus. Everybody wants more inflation. The only disagreement is to how much. And so once you've already surrendered the argument and you've conceded that government printing money is good, that inflation is good, and you're just arguing over the degree, you've already lost. right? So we are going to see an unprecedented amount of inflation. And when I talk about inflation, I'm talking about the real definition of inflation, which is the expansion of the money supply. It is money that is being inflated, the supply of money. Prices will react to money supply inflation by rising. Now, sometimes if prices were going to fall because of efficiencies or other things that have put downward pressure on prices, to the extent that prices don't decline because inflation prevents them from declining, that's still inflation, even though you didn't see the rising price. But as I said a bit earlier, the main reason that we have been spared the most adverse consequences of the inflation that the Fed has unleashed is due to the dollar's status and due to the confidence in the future value of the dollar. That confidence is about to be lost. And once people lose confidence in a fiat currency, you can't get it back, because that's the only thing that gives it value, is confidence. Confidence in its future purchasing power. Why would people buy US dollar denominated bonds that don't mature for 10 years or 20 years or 30 years unless they had confidence in what they could buy with that currency at a distant point in the future? Well, when people wake up to the reality of what we're doing, nobody is going to have confidence in the dollar in 10 or 20 or 30 years, right? Let alone, they may not, So what are they going to do? They're not going to buy. All of the buying for US dollar debt is going to vanish. And the Fed is not going to be the buyer of last resort. The Federal Reserve is going to be the buyer of only resort. The only buyer of dollar denominated debt will be the Fed. Why? Because the Fed doesn't care how much it loses, and all the Fed has to do is print money. The Fed is not loaning its hard-earned money to the government, hoping to get it back. The Fed is just printing money that costs nothing and buying bonds because they're the only buyer in town. They're the only way to keep this thing going. But of course, when that happens, it really doesn't matter how much money the government spends if it doesn't have any value, if nobody wants to accept it, if people no longer have confidence. That is where we're headed. And of course, the worst possible scenario would be a complete collapse in the value of the dollar, hyperinflation. In order to avoid that, the Federal Reserve is going to have to do the one thing that it's resisted up until now, which is the right thing. Allow interest rates to rise to where the market wants to take them, just like Paul Volcker. And I think that point would probably be much higher than 20%, especially when we get an inflation rate that is much higher than what we had, even the way the government measures it, much higher than what we had in the 1970s. And that's going to require a massive collapse of our entire financial system, our entire economy, because debtors will not be able to handle that type of interest rate. And so we'll have this much worse financial crisis. But if the government doesn't have the guts to do that, then it's just all a currency crisis. But either way, the dollar is going to lose a lot of value. Gold's going much, much higher. I used to think that gold was going to go to 5,000. This was, back in 2004, 5, and 6. We're going to get to 5,000. We're going to get there later than I thought at that time. But now we're going to go much higher than that. Gold's probably going to 10, 15, 20,000, maybe higher, because of all the additional damage that's been done since then. All the years that we kicked the can down the road, we made the problem so much worse. So the crisis that I was worried about back then is going to be much worse based on how many years we succeeded in delaying it. But the delay came at a great cost because we have so much more debt now and we're printing so much more money. The dollar's crash is going to be much more spectacular. It's falling from a higher level and it's got much further to decline. And that means gold is going a lot higher. And again,
Peter?
This is not just the US, right? This is a global phenomenon. All the world central banks have followed the Fed's lead. Everybody has created too much money. And so gold is going to be going up in all currencies. So people all around the world need to buy gold, but Americans in particular, because I think the dollar is going to win the race to the bottom. And I think the people that really want to profit, right, not just preserve their wealth by buying gold. If you really want to profit, then you want to buy the gold mining stocks, because I think that's the best way to do that. And people who are interested in doing that should check out my company, Euro Pacific Capital. We have managed accounts in gold stocks. I manage a gold fund with Adrian Day, who's going to be on our panel tomorrow. And you could buy our gold fund, any discount broker, or you can set up an account with me. But I think this is where the big fortunes are going to be made. These are the real COVID stocks. It's not, the Zoom videos or the Netflix or Tesla, whatever. The gold stocks are going to be the primary beneficiaries of the current monetary policy. And this is where your money should be going if you're willing to take the risk, because I think the rewards are going to be spectacular. Anyway, am I out of time? Is there time for questions?
I wish there was, Peter. You had just fabulous comments there. Great presentation. A lot of very valuable information. Quite a few questions were posted, and you answered quite a few of them as we were ending the session here. So I want to thank you.
You said you were going to give me a heads up when I had 5 minutes left or something.
And I was going to try, but you had some great comments, and I didn't want to interrupt you. So no, it was really a fabulous presentation.
I was waiting for that. I kept I was trying to talk until you told me it was time for questions.
Right. Believe me, I was thinking about it. But anyway, I do want to remind people what you said. Tomorrow, there's going to be another presentation that Peter's going to be involved with Brian London, Rick Rule, Adrian Day at 5 p.m. It's putting it all together, what the trends in money, metal, and mining mean for your portfolios.